Well, good afternoon, investors. Welcome to our April 22nd, 2025 edition of Bull Sessions. My name is Mark Robertson. I am founder and managing partner of Manifest Investing and a volunteer for the Mid-Michigan chapter of the National Association of Investors, also known as Better Investing. And I'm joined here by my dear colleague, that magical, magnificent mathematician from Mid-Michigan, Ken Cavula. Good afternoon, sir.
Good afternoon, Mark. How are you? We need new pictures, both of us, okay?
And yeah, well, I think Steve Emmerich's not here with us today, but I think Steve took that picture, if you recall, when we were in Illinois a few years ago.
Could very well be.
Well,
That was more than a few years ago. We were down in where were we in Illinois?
would
Right,
have been
somewhere in the middle.
probably near Springfield, would be my guess.
Yeah.
And all right, and speaking of magical mathematics, we are also joined by Matt Spielman from Houston, and he's the one watching all the tariff stuff. So, Matt, have you invented a new form of the new math when it comes to tariffs, or is it a work in progress?
Oh, they don't seem to need me to do that. I'm waiting for someone to write the book, the Cliff Notes version of the book.
Yeah, it's been interesting. Anything hot off the press today, or?
No, I will say, and it's, there's plenty I don't post as much as I do post in there. There was a very good analysis, I thought, from a cash supply perspective that I posted off the Wall Street Journal this weekend. There was some people trying to make waves. JP Morgan came out, so not Jamie Dimon himself, but the department of JP Morgan Wealth Management came out with some scenario planning, and I thought it was pretty pedestrian. They said, well, the base case is what we thought before Liberation Day happened, would be 10 to 20% tariffs, and it could be better, it could be worse. And I'm like, well, anybody could have posted that. So I didn't think that was interesting enough. I didn't think that added anything to it. Well, for sure, who was it who posted that? James McIntosh posted over the weekend. I thought that was a very, not picking sides, not anything, a very sober view of how does this work, not just with the tariffs, but with how the Fed might interact with it and sort of the other things around it too.
Well, I still maintain and stand by my Nate Bargatze meme from a couple weeks ago, where I basically said nobody knows. That's probably the QED at this point in time. So
yeah, there was another piece around the edges that interviewed a number of smaller business owners, and in fact, coincidentally, a number from Michigan, not all of them. And basically, I'll say it's a consensus. It wasn't a roundtable; it was individual interviews, but all of them are essentially hunkering down for 60 to 90 days, eating their inventory. One of them was stashing. It was false eyelashes made in China, shipped through Mexico. They're basically piling up, waiting to see what happens. So. If the small business view is anything, I'd say, as that 90 days is not just about the length of the Liberation Day pause, but also about what a lot of businesses work in process inventory or saleable inventory is too, and that's where we'll really feel it.
Absolutely. Well, I can tell you with some confidence, and I don't think I'm telling secrets out of class, but I sit about 100 feet from a desk that controls a number of automotive assets, and I can assure you they're doing similar things, Matt, right now as we speak. So good stuff. All right, well, let's go ahead and get started. The Doge dog is there just to prove that we were Doge before it was cool, Ken.
He's been rechristened. Okay.
Well, he's been on our page for years, before.
Okay, I know he has, but he never was called Doge before. So
I think Elon owes us some royalties for this.
Oh, all right. Very well.
Some of the other stuff going on, we've already talked about tariffs. I'm in the middle of the update issue for the oil and gas exploration companies and a number of things. It includes Disney, by the way, and Yeti. But earnings season is ready to start, and we're kind of hanging on this quote from Charlie Munger about, and we're going to dive into that a little bit deeper here today. All right, here's our weekly reminder that Portillo's is not a sponsor of this session, but they should be. And Ken, I'm interested in your thoughts on hot dogs for breakfast. What do you think?
I just don't think I could do it. I'm sorry.
I think we should probably do an audience poll. I think I'm willing to try it. I mean,
Well,
they say they have 3 new breakfast sandwiches. One of them has to be okay. Kim's not here; she's traveling, so I'll bet you Kim will have a report for us pretty soon.
it certainly looks messy, I'll tell you that much. Okay.
And so do the graphs. The graphs are a mess. We are gonna at some point in time spend a little bit of time with what they tell us. And that point, the one on the right is an Ishimoku cloud from technical analysis. I do not yet know how to really comprehend it. But Ken, I'll tell you, I sat here staring at this earlier today, and that Chaikin money flow graph at the bottom, that CMF, that
Yep.
represents money in and out of the stock. How is that dramatically different than the price bars up above? I'm just trying to. I actually stand on my head every once in a while and try to see what people might be thinking, and I don't know. I come up a little bit empty.
I think at some point you get enough tools, you don't need any more in your toolbox. So that's my reaction to some of this stuff. Okay,
Well, fair
it's
enough. I will point out from the graphic, we do use relative strength index from time to time for entry points or potential exit points. And if you look up here at the top, that is a time when the company was, according to the price chart, potentially temporarily overbought. And then you look down here and you see this peak in the stock price. And the opposite of that condition is periods when you get down to a relative strength index around 20, you see one there and you see another one here. That is suggesting that 10, maybe 9, if you had an inclination or a reason or a hope that you thought this stock might be worth owning, this graphic, at least to me, is suggesting that when it's down around 9 or 10 is what you ought to be patiently waiting for. And that's not an endorsement. The disclaimer slide's coming next, but that's the one thing that does kind of line up and make a little bit of sense to me. And Ken just
I'm
laughs.
chuckling. I'm chuckling, Mark. I can remember back. I have memories that go back to when I was 5 or 6, and I can remember standing in the garage of my home in Ohio and listening to my mother declare to my father that she was placing a moratorium on any new tools. Okay, he had just come back from Sears with a couple more Craftsman things to try to squeeze into his toolbox, and that's where I learned the word moratorium. Maybe we need a moratorium on any more new tools at this moment here. Okay.
All right. Well, okay. Begrudgingly hits the next slide. All right, here's your reminder that no investment recommendation is intended. This session, we're going to try to keep them under an hour if we can. It's for educational purposes only. It's basically here to share what we have collectively observed about the modern investment club movement when it comes to the discovery and analysis of opportunities. The neat thing is we share those discoveries and we actually walk through and attempt to understand and do better, be more successful together. That's what we do. So you'll hear opinions from us. The modern investment club movement has an incredible track record that's a pretty well kept secret. I'd like to see that change someday, but that is really what it comes down to. If you're out there listening, if you're in a club or with a personal portfolio, please, please, please do your own homework and make your own decision about anything that you pursue. If we own something that we're talking about, we'll try to remember to disclose that. And the resources you acquire and deploy, that's all up to you also. If you'd like copies of the slides or if you have follow-up questions or suggestions for future topics, we're starting to get more and more of those, Ken. So we're going to try and knock off a question a week if we can maintain that discipline for a while. And I think it'll add to what we do here. Any other thoughts?
Well, there's some method to my madness about talking about some of the new things that we talk about. I don't think we should ever be giving people the idea that to become an experienced investor, and I hate using the word advanced, but a lot of our educational people in our community like to use advanced investor, and I think that's a misnomer. But What I'm thinking is before you get all intrigued and excited about a new tool, I think maybe you need to make absolutely certain you understand all the basic and the old tools that you have. You know, I think that you got to learn how to use the hammers and the screwdrivers and the saws that you have before you get into some of the really fancy doodads that are available to do single kind of jobs. So I don't want us to ever give you the idea in these bull sessions that everything we do is going to make you suddenly richer than you are at the moment, and it's going to suddenly be like a magic wand that opens up new vistas to you in your investing career. A lot of times we're talking our way through different things, and we've been known to talk our way through something for a couple of years and then just quietly leave it be at the side of the road because frankly it just isn't working very well. So you know, keep that in mind as you listen to us spiel and debate each other and bring up new things all the time. Just keep in mind that there's a really good underpinning. As Mark said, the investment club movement is based on some pretty good tools, some pretty good theories, some pretty good ideas, and you can do a lot worse than making sure you understand all of that before you progress to anything new and shiny.
All right. Well, now that Ken has disclosed that he's too tired and grumpy to search for the Holy Grail, I continue to believe that Grail just might be out there. So let's keep pressing on. Here is the market, our representation of the market for the last, it's the current quarter on the far right, that lightly colored green bar. That is the stock market as represented by the value line arithmetic average. That's basically the 1,700 companies in the standard edition built into an index to keep track of how they do, and that can be compared directly with the market. The two bumpy lines with the orangish or red dots connected represent forecasts. The top one is the gold one or orange one is the value line median appreciation projection. Again, that's the average. Think of it as the average forecast from all the companies in the book. You can see the math on the right. And the red dot is our similar calculation based on a slightly larger universe, but it stands for the median or average projected return. And you can see that's in the 10 to 12 range. Value line is at 13. So that's kind of the general forecast expectation for the average company out there right now. Now, Ken, do you still believe in averages?
I still believe in a lot of the things that are on this chart, Mark, okay? And I believe in almost everything that we talk about, okay? And I especially believe that if you're only looking at price charts, then I think you're missing the boat on doing true stock analysis. There's a lot more to looking at a stock than a price chart. And I know that's all they present you most of the time on a television program. That's a price chart. I just and Warren's true. If you're selling based on a decline in prices, then you're doing it wrong. You're not focusing on the fundamentals, and they go back to things like sales and net profit and earnings and all those good things that we talk about on a regular basis.
Yeah, I was thinking about that on the subject we'll cover tonight, Ken, and that's you know, if I were saying that, I would probably hedge it with you're probably doing it wrong, but Buffett doesn't use the word probably at all. And
I think he's pretty convinced, Mark.
Well, you know, I look back over 30 years of doing this, and when stock prices are going down in years where we have kind of the environment that we have now, I can point to a number of years where I had zero sell transactions. The sell transactions happen in the other market. Here's an atmosphere for selling here, not down here. So that's kind of the way I look at it.
And price is also not always tied to fundamentals. And in fact, when price becomes decoupled from fundamentals, and when it's just, you know, based on rumor and innuendo and the whims of whatever people are happen to be talking about at the moment and is not based on what the company itself is doing, then price sometimes offers opportunity, but many times price doesn't tell us very much about the quality of the stock at all.
Absolutely. All right, let's keep pressing on. Here was a question or a comment that came up about a week ago about the death cross. Talk about price charts. And this, the only reason we bring this up is to offer you the definition at the bottom. And as Len Douglas would tell you, it's real. I mean, when it happens, some of the robots kick into motion and do their algorithmic trading, so it can actually deepen a nasty situation. So we are right at or very near one of those points, and that aggravates the other stuff we've been talking about. So, yep, we're there. We asked the question, there's the answer. Here is your groundhog update. It was another difficult week here. Yesterday was a difficult week in the stock market. We dropped back down to minus 17.9%. We were at like minus 11, so that tells you how bad it was. The average stock is checking in at minus 14%. 32, or almost a third of you out there are beating that. I am not. In fact, I am sub monkey, so it's kind of a tough year so far. But I do think a robust number of clubs have joined the fray here. So, Ken, what do you see?
Well, I want to acknowledge my grandson in spot number 2. I promised that I would mention his name if he got up into the top 20, and he's been hovering in the top 10 now for the last 7 or 8 weeks. So that's Ethan Dunman up there in spot number 2, the only behind Warren Buffett. So he's in really pretty good company. I'm very pleased.
He's got $528, so he should be buying dinner tonight.
I did promise Don Sheets that every time he was in the top 10, I would mention his name. But Don, you're not in the top 10 anymore, so I don't have to mention your name anymore, okay? But other than that, we have 9 clubs, and that's still kind of at a low point in the top 40. 9 clubs, and we've been keeping track of it since the beginning. We hit a high of 12 clubs in the top 40 and then sunk down to 9, have remained there at 9 now for quite a few weeks. So I am happy to say that I belong to one of those clubs in the 9 that are in the top 40. That's B.I. Baker right down there at number 40, just squeezed into the top 40 there. And Kevin Galogli and Kurt Kowitz up there at 18 and 19 are really setting up for all the rest of us to try to follow, Mark, okay? Are you getting any feedback from either one of them now that they sit very high above the leaderboard here?
I don't actively seek feedback from Kevin.
Okay. I just don't think you have to actively seek it.
It comes naturally. I will point out that this is Brent Koenig's club out of Maryland, or a group entry that he's got, and some pretty good stuff. That Penn State number 9, that includes our colleague Sean Mace, so he's in there too. And Broad Assets, a 3-time champion club out of St. Louis. We're going to talk about St. Louis here in a few minutes. Ty Hughes checking in the top 26, and just a whole bunch of names. Both Gombars are on the list, Ken.
I know they've been very good stock pickers over the years. They live down in Holly, Michigan, quite near where Mark and I live, and both of them have been excellent stock pickers. Anna's actually won the contest twice, I think. She does. She has 2 stars on her name there, right? So we'll see what happens. Those Broad Assets from 90 up to 22. That's quite a move in 1 week, isn't it?
Yeah, and Ken Williams.
I was just going to look at Ken also, from 135 up to 32. Yeah.
I think that was mostly affected by Uber. I think that was the biggest influence there. And last but not least, but clinging with white fingernails, white knuckles, Steve Emmerich at number 50. He's the reason we're dropped down to 50 in the. Okay, whatever. All right, here's our performance perspective perspectives, just giving you a feel for how some companies have done over the trailing 10 years versus some of our demonstration portfolios, and this entire realm of indexes we refer to as index central, different flavors of indices that are tracking different parts of the market or whatever. And we just like to put this out there, knowing that many of the people gathered here own a number, and for many of us, a large number of those 10 stocks that are listed on this page. And just a whole lot of fun.
And the fact that we're willing to list the Buttonwood portfolio on this list just shows how difficult it is putting a beginning portfolio together in the throes of a bear market. So we still have great faith in the portfolio. We'll kind of watch it for you in public, and we hope to bring that up to at least a green number, if not a green number bigger than 5, at least a green number by the end of the year.
Yeah, I hate to put any time frame on it. It could be a work in progress for a very long time, Ken. Who knows? Yeah, I was smacked with a 2x4. I'd made a math error and actually thought we were in the green numbers, and we weren't quite yet. So.
Yeah, well, you sent me an email, got me all excited. So you got to watch those emails, okay?
I know. I check your work. Measure. What is it? Measure twice. Cut once.
Cut once after you measure twice or 3 times. Yeah.
Well, here's a look at that Buttonwood performance over the last month or so. We are actually down 13% over the last month, and I get such a kick out of Robinhood putting up these non-scaled graphics. That's what they look like at Robinhood. It's just amazing that that's okay with people. As an engineer, it just makes my skin crawl. But we have dipped down a little bit on the portfolio par. That's due to a little bit of a moderation of expectations for Lulu, of all things. But you can see that we have dropped back down near the bottom for the last month. This number is still fairly healthy, and that's the number really that probably matters the most. Keep that next to last and last column in shape, and you'll be doing okay. So we'll keep visiting this one a little bit. Probably switch it to a month to month at some point. Any thoughts, Ken?
Other
than
we got to do better. That's my thought. Okay.
Well, you know what? History says that after going through a period like this, good times are ahead. And this is straight out of the Ben Carlson playbook, pointing out that after major drawdowns of 15% or worse, and we're there, basically, given 3, 5, or as much as 10 years, those are pretty strong numbers. So,
interpret the red dots, Mark, on the graph. I'm not quite sure what I'm seeing when I look at those red dots.
I think it's referring to the amount of stocks that actually recovered to a positive gain.
Okay.
If I recall, that's my guess. Percent positive, as you can see up here.
And then those are not annualized numbers. That's total return over the next 1 year, next 3 years, the next 5 years. Yeah, I know that you're used to seeing annualized numbers, but folks, these are total return numbers over those time periods.
Mm-hmm. Okay, pressing on. And all right, I have to tell the audience that I put this slide together. Again, this is another Ben Carlson. You can see it's an article that he put out pointing out that, yes, there's another recession on the way. And I'm told by both Ken and Matt Spielman that they both held their phone up to that barcode on the left to see where it would take us with their cell phones. It does look like a barcode, right?
Mark, I just love the quote up in the corner, and there's many variations on this quote, but you can't watch television right now without hearing somebody predict a recession's coming, and every one of them is right, but none of them are willing to tell me when it's going to happen. So I think, yes, there is one on the way. We just don't know when, and nobody knows when.
Yeah, we could bring back Nate for this one also. And Matt, you had pointed out that that there's actually a point on that box on the left where the modern investment regulation came into place.
Yeah, the SEC's regulations, 1934, really, but 1933, 1934. And while there were still fairly frequent recessions in the period just after World War II, what really makes it look like a barcode is not all the bars are evenly wide, right? Those are durations of the recessions. And you can clearly see something changed before and after to moderate those durations of recessions, which as long-term investors should give us a lot better confidence in sticking with our long-term theses, right? We can outlast the irrational periods of the market.
I think what's also really evident on the left of that yellow line that you drew, Mark, is the fact that a lot of those bars to the left of that line are really wide, which means the recession lasted for quite a long time, maybe even more than a year. Whereas you get to the right side of that yellow line and the bars are all fairly narrow, including the most recent one, which was COVID, which is so narrow you can barely see the line even. So,
yeah. A couple other observations. Keep in mind that somewhere in the middle of this graph is when George Nicholson was sitting down and building that tool we know as the stock selection guide. This was the magic number for the 10 years of history. The fact that at that time, he was thinking recessions happen every 5 years or so. He wanted to catch two periods of great challenge. The testing of metal, however you want to think of it, whatever a recession is, that's the reason that the stock selection guide has 10 years of history. You're looking at it right there. So that has changed a little bit. Sometimes you got to look back a little further and more carefully to the last time a company was seriously challenged. And so I guess here's the next question. A recession comes. What does that mean? Can you play the role of the journalist or the analyst? I mean, so what? What does it mean to us as investors?
I think some of them are really significant to us as investors. I think the 2008 recession was significant to anybody that was alive that had money invested anywhere, even in money markets, which many times were breaking under $1 and were frozen. You couldn't get your money out of a money market even. But I think most recessions come and go, and I think more often than not, the average person doesn't even know they're in recession unless number one, somebody beats them over the head and keeps telling them they're in one, or number two, they look backwards and they at a graph and they say, oh my goodness, I just lived through a recession and it didn't really affect me all that much. I think that part of the problem that we're having with fearing an oncoming recession to such a degree is that the last two recessions have been, one of them extremely disastrous in 2008-9, and then one of them just didn't fit the mold for anything. The COVID recession didn't fit the mold for anything that we had any experience with. So that's the two recessions that a lot of our personalities that are talking on television have as their data set to draw conclusions from. Many of them don't even remember the recession that happened at the turn of the century, 1999 into 2000. That was the dot-com bubble. And if you don't remember things like that, then I think that you're going to have problems understanding that they're not something you want to wish for, but at the same time, many of them are fairly benign as far as the market's concerned. And I think that graph you showed us prior, Mark, kind of points that out. Set of growth numbers. Yeah.
I think of a couple things, but Matt, what's the first thing that comes to mind when you think recession?
Sale. I do think there's work to be done, right? There's an amount of optimism or discipline to hold to things that aren't being thrown, the babies that aren't being thrown out with the bathwater. I do think they're interesting points or interesting ideas, long-term opportunities that do come out of them. For example, that's really a lot of my thesis around home builders and green brick was not before COVID, but in the very early days of COVID. It wasn't about COVID or COVID migration at all, but the fact that the 2008 recession did very lasting damage to home building, and we were still kind of digging out of that.
Mm-hmm.
And you can think about in COVID itself, there were theses to test. Was Zoom and video conferencing, permanently ratcheted up? Was everyone staying at home in Peloton by choice or because they had to? And were restaurants a good deal or not? So it's not just the fact that they happen in general, that the whole market is an opportunity, but as people's habits change, whether it's because they have a job loss for a time or something isn't available, they do without some luxuries at times, and then either they realize that they didn't value them a lot, or they want to double down on them, right? The idea of revenge travel. So there are a lot of specific points that could be red herrings, could be just as big fads as fads happen when bull market's at the top. But there also are some permanent changes, just as you were talking about, Ken. People forget. We'll get to Cactus in a little bit, but as we were talking about that beforehand, because they deal in the oil industry, people forget that in early 2020, oil futures were actually negative. Right. What would that do for them for a while? And what, would that be a permanent situation or not? And that's kind of the first thing. Whenever I hear about something that's changed or someone has an idea, that's pretty much the first thing that pops in my head. Do I think that's lasting or not? So it would be worth my attention and my research.
Cool. Well, I think 2008 was a legitimate financial crisis and challenge. I read a paper that basically said most recessions go by unnoticed, but the other one that the author pointed out was 1974. The reason he pointed it out was because that was driven by the oil embargo and the inflation characteristics back at that time frame. So that thing was a monster, and it went relatively unnoticed by me. Because I was in college at the time, and I barely knew about any of this stuff going on. Mom and Dad,
you youngsters forget the fact that in the 70s, the common knowledge was that we were going to run out of oil completely within the next 5 to 10 years. So, those of us that have a little bit of years attached to our age remember things like that. And, I always like to think of the pendulum swinging in both directions. We've talked about this a number of times before, but I think right now we're at a period where the pendulum has just swung so far in the negative direction that nobody can see anything positive about anything going on. I saw that happen during the .com when the pendulum went so far to the right, to the euphoria side, and then I saw it happen in the oil problems too, when the pendulum swung so far to the left that do you remember, folks, that we even had laws that confined our speed on the interstate highway system to 55 miles an hour? Do you all remember that? I doubt if many people do.
The biggest thing that points me to paying attention to that 70s era is, and a lot of people wouldn't guess, if you guess what period actually caused Bill Bengen, the inventor of the 4% rule, to come up with 4%, most people would guess the 1929 crash and the Great Depression, but that's not true. The actual worst time to have retired in the past history up till, let's say, the 1980s, because you have to go back 30 years, is 1966. And it was because you were heading into the high interest rate and high inflation of the 1970s.
Right.
That is actually the scariest situation in terms of real money that we have, at least so far, encountered.
All right. Well, if you want to talk scary, let's talk about my groundhog portfolio for just a second. One of the other things that you learn in a recession is it's not a great time to have a bunch of small companies, and it's especially a bad idea to have a bunch of small companies that are triple leveraged. So we'll put my portfolio up here at some point, but what I need is for this recession to start getting over, because what Peter Lynch taught us was as a recession begins to draw to an end, it's a really cool time to go shopping for the small companies that have been massacred. And I've got all of them in my groundhog portfolio, so you guys know where to go shopping when this recession starts to end. So enough about this recession thing. All right. So let's talk about some other stuff. I thought this one was kind of a cool thing to observe. The roundtable, that's our monthly webcast. We'll be doing that next Tuesday, working with St. Louis on that program. But this is actually Hugh McManus's first pick in the history. It is actually the first stock selected in the roundtable back in July 2010, Eli Lilly. And what you're looking at the top of the page is we actually sold Hugh's beloved Eli Lilly. He still owns all of his shares of Eli Lilly. And trust me, his day job is in that environment, so he knows what he's doing. And we sold it 2.5 years after we had originally bought it. Actually, is that 2 years? Yeah, 2.5 years. And we actually had a really decent gain in it. At the time, the outlook was murky at best, and we kind of walked away. Well, the second line there is, well, what if we hadn't sold it? That $24 stock would now be worth $830, $34,000, still outperforming the market by 14%. Now, the really thing that's kind of perplexing about Lilly, it has been for many of us, is that stock selection guide visual analysis on the lower left. It's not exactly up straight and parallel, and it perhaps is a little bit flat. Is that fair to say, Professor?
I think it's more than fair to say, because there were long periods of time when I wouldn't even give Lilly a second look, Mark.
Yeah, and I understand where you're coming from, but when you deflect your vision a little bit to factoring in the cash flow for the business, and you read Hugh's words again, he's a analyst, a forensic scientist in that area. Um, Again, I take him at his word, and he basically would argue that they're doing just fine, and they are very creative and innovative, etc. That cash flow graph actually does represent some of the spending that they did with the GLP-1 drugs in 2023. It's obviously COVID impacted also, but obviously that GLP-1 pipeline has been serving them well here over the last couple of years. But the long-term trend is pretty strong when it comes to cash flow, perhaps a little more obvious than the earnings side of the question. So,
yeah, I didn't want to disparage that sale that we made either in the roundtable, though, Mark. I mean,
oh no,
selling something with a 38% relative return, as long as you have a place to something to replace it with in a regular portfolio. You know, a tracking portfolio, you're not going to take that money and reinvest it. But in a regular portfolio, selling a stock like Lilly that ended up with the characteristics that we see from 2014 through 2023, maybe, probably wasn't that bad of an idea, provided you had a good place to put the money, the considerable money that you made from the sale.
Absolutely. So again, I think 38% placed that on the Hall of Fame leaderboard at the time, near the top. So good stuff. So again, just be willing to consider a different perspective on the companies that you study is kind of the message here, and it dovetails in with the experiment. This is definitely group head scratching amongst all of us here. We are just openly exploring this concept that Charlie has laid out for us, and that you basically want to be mindful of the underlying business, and we do that. I mean, I'm not suggesting for even a heartbeat that we don't do that, but Charlie's observation could be basically that these three items that we're going to look at here in a second could be complementary to each other or supportive. Anything you'd like to add to that, Ken? The way I say it
I
is
think
those numbers.
I think that's a good way to phrase the study right now. And this is a work in progress. It's something that is being actively debated among ourselves at the moment, and we're trying to understand the relationship between these numbers and trying to figure out why the numbers are so different in some of the companies when they're so consistent in other companies. There has to be reasons, and we're trying to wade our way through those reasons.
And we'll come back and take a look at this one in particular. Keep in mind that Apple back in the 2015 timeframe had a PE ratio of about 10, and it actually expanded up to 25 to 30. So I think that's going to explain a big piece of that difference. So we'll take a look at that and see if we can't find a way to capture the spirit of PE enhancement. So we'll come back to that, but this is the kind of the thought experiment that we're going through. We kind of like, and I'm really sugarcoating, I really like being able to reconcile my projected return forecast from a stock selection guide versus the projected return on value. And we're going to actually look at the calculations and remind ourselves what's involved with that. And then we're asking the thought experiment, if Charlie's right, those three numbers up there for those three companies, which by the way are the top three companies in this week's update from the Value Line Standard Edition, issue 12, those three numbers should resemble, and I'm doing air quotes, Ken, should resemble each other over the long term. And I think we might find that they can provide some of this reconciliation or audit. How do you think about it, Ken?
That's exactly what I'm looking for, Mark, whether they can validate the analysis that we do with a traditional projected annual return. There has to be something to the cash flow concept because it's used entirely to do the calculations in value line. The value line is a cash flow line essentially. I mean, it's modified, and they have some algorithms that they use to come up with some of the numbers. But in essence, they're looking at cash flow, and they're deciding whether a company is valued or overvalued or undervalued based on that cash flow line that they create. So there has to be something to it, and there has to be a reasonable explanation for why a lot of the companies have the three numbers clustered together. And there are certain companies like these three where the cash flow growth is significantly different than the other two numbers that are kind of singing the same tune.
Yeah, and as we talked about this before the session, I think we're still in the mode of gaining perspective and better context. The way I would frame this to my way of thinking, if I'm doing a stock study, let's say I were doing a stock study on Cactus and I was coming up with a 29% annualized return and this number is 13 here, I would want to begin to question my assertiveness, my aggressiveness in that analysis. Because again, if we think that the long-term returns are going to somewhat in some way approach or resemble these numbers, I think we want to develop that context, that perspective, and that's really what this effort is all about.
Well, and we did make the point, Mark, that it's taken more than 3 years, or maybe 2.5, 3 years, for us to feel confident enough about Prove to begin to include it in the database and to begin to use it to validate our stock selection guides. And we are pretty confident that when the par value and the Prove number vary significantly, and in these three stocks they don't, but when they do vary significantly, we're telling ourselves that maybe we have to kind of rethink our judgments as far as PE values are concerned when it comes to doing a projected annual return. That's always been a bone of contention when people do the stock selection guide. Choosing PEs that are the high average and the low average, and then coming up with the average and all that kind of stuff has always been the most challenging thing for people to do on a stock selection guide. And we think Prove kind of helps a little bit in giving people either a thumbs up or a thumbs sideways when it comes to the last number, which is the par value.
Yeah, so we're going to take a look at Cactus. Now, keep in mind that if you're not familiar with Cactus, it's a company very much like Schlumberger. Much smaller, a little bit lower quality, but still a good company. I would just point everybody to the fact that these numbers are all pretty much the same for the return forecasts for the two companies. And the way I would interpret this going into it is, even though it's smaller and a little bit lower quality, it's just quite possible that this is a plus, that there's perhaps a little bit more support when it comes to Cactus for the next 3 to 5 years. A little bit more ground cover, if you want to think of it that way, from the cash flow. So let's go ahead and take a closer look. We'll come back to this, but basically all the numbers, with the exception of some of the approved numbers, which come from Morningstar. Here's your data array for Cactus. We have added to the forum postings on some of the companies this little gem. That is basically just correcting for changes in price or time frame, and it's basically bringing these two numbers up to date for any changes and basically performing that calculation. So when I look at Cactus, I'm seeing a company between 14 and 26%, the way that we look at the world. And yes, the price is down substantially below the value line by that dot on the far right. Okay, so Ken, here we go. Here is a look at a traditional projected return calculation. The company that we're talking about, Cactus, has been improving in quality over the last time frame, getting financially stronger over that time frame. Coming out of COVID with a period where their projected return, their return forecast, actually peaked. I think that's when Betsy Wills first noticed it. And Betsy has been a contributor to our sessions here. So I'm looking at this as an opportunity to explore, what this company has done. You could actually make a case for maybe a slightly higher growth rate, but here is the look at the couple of the most recent years and a couple of years of forecast, suggesting call it an 8 to 10% slope for the sales growth forecast. That lines up pretty well with the earnings down below. So you're basically looking at, let's call it 8, okay, with a PE of 15, which is pretty normal for this company, and ending up with a projected annual return as a Section 5 result, the average return, on a stock selection guide of 17.3. What jumps off the page at you, sir?
Well, I think that your regression line for sales shows that sales have been flattening a little bit compared to what they might have been doing from 2020 through 2022. And maybe as the company is growing, this is not a huge company. It's only a little bit over 1.1 billion now in sales, and we would expect sales growth to moderate and maybe become more predictable as the company gets larger and larger. Price has kind of followed the sales, and we've taught beginners to chant earnings follow sales, and the earnings are certainly in line with the sales, and in fact the two lines are kind of moving in tandem with each other at the moment.
Absolutely.
And that flattening, I don't think, is very unusual for a company of a very small size moving into a medium-sized company. I think it should be expected.
Okay, so here's our audit. And this is the audit that we've talked about. The projected return on value is basically borrowing. The only thing in common that these two have is the sales growth forecast. Okay, we basically borrow the sales growth forecast over here to build a 5-year sales growth forecast against which we can apply a projected reasonable, here you go, Ken, reasonable operating margin in order to form the other number. This is the projected operating margin is the dominant characteristic of the projected return on value. And here's a picture of it. So as we're thinking about this company, you basically take a step back, close one eye, and I'm basically saying that, 32 to 34 looks pretty reasonable if they can continue on their current trajectory. Okay, when you do that and you put in the numbers for the enterprise value, again, that's calculation is shown right here. You can peel the numbers off Morningstar for the market cap, total liabilities, cash on hand, and treasury stock. You end up with that denominator, and that leads us to a projected return on value of 19.2, which Ken has pointed out a number of times is the same as that number. Your thoughts, Ken? Does this reconcile? Do you think a PE of 15 is
I do
reasonable?
think it. I think they reconcile. I think that PE that we've used in the first calculation, which is the traditional it's the traditional calculation that we do, and I think that there's not much adjusting that needs to be done. I do notice the annual rates box that you've captured from Value Line down in the bottom left corner there.
Mm-hmm.
And I do see that Value Line is being especially frisky, aggressive. You decide which words you want to use for the future compared to the past. One of the beginners things that we teach beginners, we tell beginners that in the beginning, as you're learning to do an analysis, you hardly ever estimate future sales growth and future earnings growth higher than the history suggests. But Value Line has gone out on a limb, and heck, it's tripling the earnings growth and almost doubling the revenues, the sales growth going forward, and it's quadrupling plus the cash flow growth.
Yeah,
so yeah.
I didn't leave the slide in here from last week, but we talked about how if you start, well, here, let's use the next slide. If you start using any of these numbers in this time frame here in your calculation, which is what Value Line does, they basically take the average of these three numbers and compare it to this number, and that's how they end up with this cash flow number. That number is, I'm going to sugarcoat it and say distorted. And that's why we use a regression which comes up looking at virtually the same time period of 13.2%. Okay, so keep in mind that those numbers in that column are still subject to distortion, and be careful. Be careful.
Well, I think that graph you just had up, Mark, with the green dots on it, if you go back to that one, points out that that point floating up there on the 2029 line has a pretty significant change in slope from 2026 to 2029.
Yep.
Much more steep than the slope from 2023 to 2026. So Value Line sees a bright future for this company, an extremely bright future. And maybe that's the kind of thing that this cash flow will help point out, that I'm not sure what the final conclusion would be, but I do know that the fact that these numbers aren't in tandem with each other is interesting right now.
Yeah, because you're basically looking at the cash flow graphic and trend for Cactus, and to me this does look a little ambitious out here, but maybe not. Dig in and see if they might have a reason for that. But even with that in place, the real number is more like 13%. That's actually a pretty strong number. The average right now, I've now done about 500 of the 1,700 companies in Value Line. The average is checking in right around 8%. So this is a superior projected cash flow growth. So again, a sign of more strength. So like I said before, Ken, we're going to get more context as we do this a little bit more. The two things I take away here are these numbers are virtually on top of each other. They're not wild and crazy. If they were anywhere between 30 and 40%, I might say, okay, time to dial back the PE or whatever. This has strength in 3 directions. The other thing is be careful starting any regression or trend analysis in that gray box, anywhere in that gray box, or a point-to-point calculations, even more dangerous.
Yeah, 2 points do make a straight line, Mark.
and the math's easier, Ken. So I guess that
Much
makes it all
easier,
right.
yeah.
So again, I think we'll get more context as we keep rolling on this. But this does show kind of how you can stack these up side by side and come to these types of conclusions. All right, so we'll come back. I will be visiting. I'm probably going to be traveling a little bit over the next few days. I will be spending a great deal of time with the evaluation of common stocks by Arnold Bernard from 1959. And is it ever a page turner? But we will be.
Don't read it while you're driving, Mark, okay?
I will not be reading while driving. Well, here.
And don't listen to it while you're driving either, okay?
Well, here is our. Now, be nice to Arnold. Arnold did some great work. All right.
Yeah.
So here is our question for the week, Ken. And after praising some of the stuff and liking some of the stuff that we do, he would basically like to tackle this notion of a fair price or fair value as it's referred to by Morningstar and some of the other services. And I think this is a fairly decent way to think of it. The value line, or excuse me, the Morningstar fair value estimate is laid out for you right there. I do find it interesting that they consider where the company is in its life cycle as they do it. Their proprietary discounted cash flow model is simply a stock selection guide on its head, standing on its head. That's all it is. They basically are doing it just the opposite of what we do, but they do the same exact thing. Present value of all future cash flows discounted by what that costs. So again, you see the type of stuff that goes into it. So that establishes that price. And you can see on the right there, that graphic gives you the fair value of Cactus. WHD is the ticker. So they're talking about this company being at a 29% discount, which would also be consistent with our previous slide. I look at the company. So is that a way to think of this, Ken, or is that how you think of fair price?
I think absolutely. I think that the paragraph at the bottom of the slide, Mark, is a very fair representation of what we think of when you and I are talking about fair price. I'm going to add a couple sentences to it. As I look at portfolios for groups of investors throughout my state and throughout the country, I notice that most of them are quite a ways away from a goal of the average +5. And we know that the long-term average in the market is 10, and you add 5 to that, and that's where you get that 15 that Better Investing talks about on a regular basis. And I like to think of a fair price as anything that will increase the total return of your portfolio and move it closer to that +5 number. MyPar +5. MyPar means the average on a given day in the market. And even though the long-term average is around 10, we know that at any given day, it can vary significantly. I think MyPar right now is up around 12 somewhere. Oh, you have it on the slide even. It's 12.1. Yeah. So today, if I were looking at a portfolio with a par value, a weighted average par value of 14, then I would be happy to buy anything at 14.5 and above that, because that would be moving me towards my goal of increasing the portfolio's par value as a whole. And that's the way I like to think of purchasing stocks. I like to look at individual stocks, but I want them to contribute to my portfolio as a whole. And to do that, you have to think of the portfolio as a whole when you're adding or deleting stocks from it.
Okay, so I just made up this phrase, a margin of reward instead of margin of safety. yeah, I like to think about, well, what's the average stock? Tack on a few percentage points to it, like Ken just said. And in the weekly stuff that we put out, we do talk about this buying return. That simply is, in the case of a company like this, we're basically talking about this number is just captured at a different moment in time as I grit my teeth and talk about how much the market moves in any given morning for over 30 minutes right now. Anyhow, so our fair value is, a little bit higher than that. So we want a little margin between that and the fair value. So we want to buy this company 38 and below. Notice that it's at 37, and this all rhymes. I mean, that means that this company's at a fairly attractive place relative to its fair value or fair price, or however you want to put it. So good, clean fun. Hopefully that
Yeah,
takes care of
I think,
Tom.
Mark, the one thing that I'd like to point out is that this orthodoxy about thinking that every one of your stocks has to hit a certain value before you can put it in your portfolio, I don't think that's what either one of us is saying. I think what we are saying, however, is that stocks that you're going to place in a limited list and then try to make money from have to, in the aggregate, they should be giving you a return better than the market. And if your return is projected at 12, then you should be looking at stocks that can raise that number a little bit. If you're already at 15 or 16 or 17, then you need to be looking at stocks that can maintain that number. So there's not one rule fits all, and it's not a static kind of a thing. And there's never something that disqualifies a stock from ownership. It's just that it needs balance. You need to keep a portfolio balanced. I just think that too many of us put portfolios together full of individual stocks without keeping an eye on the entire portfolio and what you can do by bad decisions, how bad you can make your portfolio by a couple of bad decisions in the aggregate rather than in the individual.
Absolutely. So there we go. Hopefully that helps you, John. Here's your reminder that we do archive these sessions, including the roundtables and bull sessions and any special educational sessions on YouTube. You go to that link up at the top, you can actually go back and I think you can go all the way back and check out what he had to say 10 or 14 years ago. All right. We do have a roundtable coming up 1 week from today. That's our annual, it's become an annual tradition for us to involve the St. Louis chapter. We're going to do a special presentation for the hour preceding the traditional roundtable. And then we're going to go into the traditional roundtable right at the normally scheduled time of 8. You can show up for one, either, or both. That's up to you. And I'll let you guys read away at that. So we are going to have some fun with our friends, our dear friends in St. Louis. Anything you'd like to add to that, Ken?
And folks, we're going to try to keep this a beginning class on machine learning, and we're trying not to use that AI word very much because it's been so overused. But we're going to try to keep this class approachable and not only telling you the results that come from some of these products that are out there right now, but how you can access them. Many folks have the idea that you have to pay big bucks to get access to a lot of these things, and that couldn't be further from the truth. So we'd love to see a lot of our community begin experimenting with this thing and begin communicating with each other about things that work and things that don't work, because I think both lists are very important for us to keep an eye on and to internalize, because there are still things that these machine learning things won't do for us. And when they do something, I think we have to hold their toes to the fire and not forget to ask, how'd you do that? Because they're prepared to tell us how they did that. Mm-hmm. And that's going to be important in evaluating whether the results are something we can actually use.
Well, I promise not to tell my jelly bean story at the round table, but I'll tell it here. We're running a little bit late, but it's important. At our Easter celebration, where our family gets together, one of our family members brings a mason jar stuffed with jelly beans. And I took out my perplexity and I said, what's an approximate number of jelly beans in a 21-ounce, mason jar or whatever, based on an average jelly bean size or whatever. And it basically went through, showed me the calculation, and the guess was 520. And on the page, all the family members, so there's like 40 of us there at this dinner, guesses ranging from 300 to 800, right? So my grandson and I said, well, it checked in at 520. So I put in 510, he put in like 490. The answer was 488. Okay, so perplexity.
We're both being beat by our grandsons today, right?
Okay. That's right. That's right. He took my jelly beans. All right, just a reminder for those of you within driving distance of Rochester, Michigan, and Oakland County, Ken and I will be appearing live at the library here in Rochester, May 10th. So if you'd like to join us for that, the registration can be achieved right down there on the left. Sponsored by the Southeastern Michigan chapter. And with that, we'll leave you with the festive groundhogs out there searching for a better stock market, although people have reminded me that this market is just generating opportunity. You just have to know how to look. And then on the right, a couple articles that are in our roll call this week. The one up at the top, the short case for NVIDIA stock, it's not an easy read, but Marie Frank provided it. It's just an interesting way to take a closer look. Matt, had you actually reviewed that yet?
I scanned the excerpt, but not read the article yet.
Yeah, I just scanned it myself. It looked good, so I just wanted to point out that that's there in the manifest forum. I think it's actually under the tariff thread. And then Jeremy Irons, really cool, margin call. That's not a friendly article, but it is a reminder of how ugly Wall Street can get. Thinking back to the Western Alliance / Silicon Valley Bank, that's exactly what that thing is about. Looking back through the eyes of Bear Stearns, and it's an interesting read. So you can find those out there on the interwebs. Anything else, Ken?
No, I've kept up with questions and comments and everything, Mark. So we should sign off for this afternoon and welcome everybody back next Tuesday.
All right. Take care, everybody. Good luck, good hunting, and find those opportunities. They seem to be getting better by the minute. Take care, everybody.
Bye-bye.
Bye, everyone.